There's a message sitting in your family group chat right now that you haven't responded to. Your cousin bought a house last month. There are photos, the kitchen, the backyard, the slightly too enthusiastic caption about finally being a homeowner. Everyone is responding with fire emojis and congratulations. You typed something supportive and hit send, and then sat there for a second, feeling a specific kind of discomfort that's hard to name. Not jealousy exactly, something more like dread mixed with confusion, because you ran the numbers on buying 8 months ago and walked away convinced it was financially reckless. And now you're watching someone build equity while you keep paying rent to a landlord you've met twice. So, which is it? Is buying a house in 2026 a smart financial move or a trap dressed up as the American dream? Is renting throwing money away, or is it the financially disciplined choice everyone online insists it is while secretly judging themselves for not owning? Here's the truth that almost nobody explains clearly. The answer is not the same for everyone, and it is not even close to as simple as either side of this argument wants you to believe. The real math depends on where you live, how long you plan to stay, what you do with the money you save by not buying, and a handful of variables that change the entire equation depending on your specific situation. I'm going to walk you through the actual math, not the talking points, the math. My name is Sig, and I spend way too much time thinking about money, housing economics, and why one of the biggest financial decisions most people will ever make gets reduced to oversimplified slogans on both sides of the debate. If you want an honest breakdown of what renting and buying actually cost in 2026, not the version that sells mortgages and not the version that makes renters feel superior, subscribe to this channel right now and give this video a thumbs up if it helps you actually run your own numbers instead of just picking a side based on what your cousin posted. Let's start with where things actually stand right now, because the housing market has shifted significantly over the last few years, and most people's mental model of buying a home is still anchored to numbers from 2020 or 2021. The current 30-year fixed mortgage rate is hovering between 6.5% and 6.8%. That is dramatically higher than the pandemic year lows around 3% that an entire generation of homebuyers got used to seeing, though it's down meaningfully from the peak above 8% in 2023. The national median home price sits at approximately $400,000, with most major data sources putting it somewhere between $390,000 and $420,000, depending on the exact measure used. Here's what that combination of price and rate actually means for a typical beer. On a $400,000 home with a 10% down payment at 6.5% interest, the principal and interest payment alone runs approximately $2,250 per month. Add property taxes, homeowners insurance, and private mortgage insurance, since the down payment is below 20%, and the real total monthly payment lands closer to $2,800 to $3,000. Nationally, the typical mortgage payment now consumes roughly 30% or more of median household income, above the 28% threshold that has traditionally been considered the affordability ceiling. Meanwhile, rent growth has slowed considerably from the aggressive increases of a few years ago down to low single digits in most markets, with some previously overbuilt metros like Austin and Phoenix actually seeing flat or declining rents. This is the backdrop against which every individual rent versus buy decision is now playing out. Let's go back to your cousin's new house for a second, because I think the gap between what gets posted and what's actually true financially is worth examining honestly. The photos show a kitchen and a backyard. What they don't show is the closing costs that just left their bank account. On a typical $400,000 home with a modest down payment, closing costs run between 2 and 5% of the purchase price. That's $8,000 to $20,000 on top of the down payment itself. If your cousin put down the median first-time beer amount of around 8%, that's $32,000 just in down payment, plus another $10,000 to $15,000 in closing costs. Your cousin likely just spent somewhere between $40,000 and $50,000 to walk through that front door for the first time. The photos also don't show the home inspection, that revealed the water heater needs replacing in the next 2 years. They don't show the property tax bill that arrives twice a year regardless of income. They don't show the homeowner's insurance premium that has been rising faster than almost any other household expense to increased climate-related claims nationally. And they definitely don't show the maintenance reserve that any honest homeowner will tell you needs to be roughly 1% of the home's value annually for $1,000 a year on a $400,000 home. For the roof, the HVAC, the plumbing, the dozens of things that eventually break and that a landlord used to handle. None of this means your cousin made a bad decision. It might be exactly the right decision for their specific situation. But the photos in the group chat are not the financial picture. The financial picture requires actual math, and that math looks completely different depending on where you live and how long you plan to stay. Before we get into buying, let's be honest about what renting actually costs, because the rent versus buy conversation usually treats renting as the simple, low-risk option and buying as the complicated one with hidden costs. Renting has hidden costs too. The most significant one is the cost nobody can predict. Annual rent increases. The median monthly gross rent in major metros recently sat around $1,500, with mortgage, homeowner costs running over $2,000. That gap looks like renting wins clearly. But that $1,500 rent is not fixed. It can increase every single year at your landlord's discretion within whatever legal limits your state allows. And in most states, those limits are generous or non-existent. A renter who signs a lease at $1,500 a month today, in a market with even modest 3 to 4% annual rent growth, is paying over $2,000 a month within 10 years for the exact same apartment. Meanwhile, a homeowner with a fixed-rate mortgage is paying the exact same principal and interest payment in year 10 that they paid in year 1. That predictability has real financial value that rarely gets calculated into the comparison. The second hidden cost of renting is the complete absence of equity building. Every dollar of rent you pay this month is gone. It does not come back to you in any form. It does not reduce a balance you owe. It does not build toward an asset you will eventually own outright. This is the core of the renting is throwing money away argument, and it's not wrong. It's just incomplete, because the alternative, buying, comes with its own offsetting costs that the simple equity argument ignores. Now let's be equally honest about buying, because the homeownership side of this argument tends to talk about building equity while quietly ignoring everything else that money is also doing. When you make a mortgage payment, only a portion of it builds equity. In the early years of a 30-year mortgage, the overwhelming majority of your payment goes toward interest, not principal. On a $400,000 loan at 6.5%, in year 1 approximately 78% of your payment is interest. You are paying the bank for the privilege of borrowing money, and only the remaining 22% is actually building your equity. It takes roughly 15 to 18 years on a standard 30-year mortgage before the majority of your monthly payment starts going toward principal instead of interest. This is the part of homeownership math that mortgage calculators and real estate agents rarely walk people through clearly. Then there's the cost of capital that's locked up in your down payment. If you put $80,000 down on a home, that $80,000 is no longer available to you for anything else. It cannot be invested in the stock market. It cannot sit in an emergency fund earning interest. It is illiquid, meaning getting it back out requires selling the home, refinancing, or taking out a home equity loan, all of which come with their own costs and complications. And then there's maintenance, which I mentioned earlier but want to emphasize because it is the single most underestimated cost of homeownership. The roof that needs replacing at year 20 costs $15,000 to $20,000. The HVAC system that fails costs $8,000 to $12,000. The water heater, the plumbing issues, the foundation work if you're unlucky. These are not hypothetical. They are a near certainty over any extended period of home ownership, and the cost is entirely yours, with no landlord to call. Here is the single most important concept in this entire comparison, and it is the one that almost never gets discussed honestly on either side. Opportunity cost. If you take that $80,000 down payment and instead of putting it into a house, you invest it in a diversified index fund, earning the historical stock market average of roughly minus 1 to 10% annually. What does that $80,000 become over time? At 8% annual growth, $80,000 becomes approximately $173,000 in 10 years with zero additional contributions. At 10%, it becomes over $207,000. This is money your cousin's down payment is not earning because it is sitting in home equity instead of the market. Now, the homeowner has a counterargument, and it's a legitimate one. Their home is also appreciating in value, often at 3 to 5% annually depending on the market, and they're not paying rent during that time, which the renter still is. So, the real comparison in down payment growth versus nothing, it's down payment invested plus monthly rent versus home appreciation plus equity paydown minus maintenance and the extra cost of owning over renting each month. When researchers actually run this full comparison across real cities, the results are genuinely split, which is the most honest answer this topic can produce. A recent 10-year study analyzing 250 U.S. cities found that in fast-growing markets like Miami, Tampa, and several cities in Idaho, the equity advantage for homeowners over a 10-year period exceeded $300,000, even in cases where the monthly cost of owning was significantly higher than renting, because home price appreciation in those specific markets was so strong. But the same study found the opposite in slower growth markets, with homeowners ending up with equity disadvantages of $100,000 to $160,000 compared to renting and investing the difference. In places where home price growth was modest and the stock market simply outperformed real estate appreciation. Let me make this concrete with two people because the geography variable here is so powerful it can completely reverse the answer for two people with nearly identical financial profiles. Marcus lives in a mid-sized Midwestern city. The median home price where he lives is $280,000. Comparable rent for a similar property runs around $1,400 a month. Marcus puts down $28,000, 10%, and his total monthly housing cost, including taxes, insurance, and PMI comes to approximately $1,900. That's only $500 more per month than renting the equivalent property. Over 10 years, assuming modest 3% annual home appreciation and standard principal paydown, Marcus builds approximately $95,000 in equity. If he had instead rented and invested the $28,000 down payment plus the $500 monthly difference into an index fund at 8%, he would have approximately $140,000. In Marcus's market, renting and investing actually wins, even though it feels counterintuitive given how affordable buying there. Now meet Lisa. Lisa lives in a coastal metro area where the median home price is $720,000. Comparable rent for a similar property runs around $2,800 a month. Lisa would need $72,000 for a 10% down payment, and her total monthly housing cost including taxes, insurance, and PMI would run approximately $4,500, a gap of $1,700 more per month than renting. But Lisa's market has historically appreciated faster, averaging closer to 5 to 6% annually due to constrained housing supply and strong demand. Over 10 years, even with that painful monthly gap, Lisa's home equity grows to approximately $310,000 due to the combination of appreciation and principal paydown on a much larger loan. If she had rented and invested the $72,000 down payment plus the $1,700 monthly difference, she would have approximately $280,000. In Lisa's market, buying wins, but by a much narrower margin than the simple equity story suggests, and that margin completely depends on home appreciation continuing at a rate that is not guaranteed. Here is a factor that changes this calculation more than almost anything else, and that most people underweight when they're emotionally ready to buy a house: how long you actually plan to stay in it. Buying a home involves significant transaction costs on both ends. The closing costs when you buy, which we covered earlier, plus realtor commissions and additional closing costs when you sell, which typically run 6 to 8% of the sale price combined. On a $400,000 home, that's $24,000 to $32,000 just to exit the transaction. If you buy a home and sell it after 2 years, you have almost certainly lost money compared to renting, even in a market with decent appreciation, because the transaction costs on both ends eat through whatever equity you manage to build in such a short window. The general rule of thumb that most financial analysts agree on is that you need to stay in a home for at least 5 years, and ideally 7 or more, for the math to clearly favor buying over renting and investing the difference. If there's any meaningful chance you'll need to relocate for a job, a relationship, or simply because you're not certain you want to stay in that specific city long term, that uncertainty itself is a financial cost that needs to be factored into the decision. Separate from the pure math of monthly payments and appreciation rates, here's something specific to right now that makes this comparison more complicated than it's been in years. According to recent affordability data, it is now actually cheaper to buy than rent on a pure monthly payment basis in nearly 58% of U.S. counties, a notable shift from the previous several years when renting was almost universally cheaper month to month nationwide. This sounds like it should settle the debate in favor of buying, but that statistic is heavily skewed by geography. The counties where buying has become cheaper than renting concentrated in the Midwest and South, in lower-cost markets with modest home prices. In the largest, most populous metro areas, the cities where the majority of Americans actually live and work, the opposite remains true. In those major metros, homeowners with a mortgage are paying on average around 37% more per month than renters for comparable housing. This is the most important nuance in the entire 2026 housing conversation. The national headlines saying buying is now cheaper than renting are technically accurate and almost completely irrelevant to anyone living in a major city, where the calculation remains heavily weighted toward renting on a pure monthly cash flow basis. Even if the long-term equity picture sometimes favors buying anyway due to appreciation, I want to address something that doesn't show up in any of the math I've walked through, but that genuinely matters to most people's actual quality of life and decision-making. Homeownership provides something that is difficult to quantify in dollars, but real nonetheless. Stability. The ability to paint a wall without asking permission. The knowledge that you won't receive a notice that your lease isn't being renewed because the landlord wants to sell or move in a family member. The psychological security of a fixed monthly payment in a world where almost every other cost in your life seems to be increasing. These benefits are not financial in the traditional sense, but they affect well-being in ways that matter, and dismissing them entirely in favor of pure spreadsheet optimization misses something important about why people actually want to own homes. At the same time, renting provides its own version of this value that gets underweighted in the opposite direction. Flexibility. The ability to take a better job in a different city without the burden of selling a property first. The absence of responsibility when the furnace dies at 11 at night. The freedom to downsize, upsize, or relocate as life circumstances change without a 6 to 8% transaction cost attached to every move. Neither of these psychological factors has a dollar value that fits cleanly into a spreadsheet, but pretending they don't matter at all produces a decision that's technically optimized and personally miserable, which is its own kind of financial mistake. Let me make this practical, because I don't want you walking away from this video with a more nuanced understanding, but no actual framework for your own decision. Start with your specific market. Look up the median home price for the type of property you'd actually buy and the median rent for a comparable property in the same area. Calculate your realistic total monthly cost of owning, including principal, interest, property taxes, homeowner's insurance, PMI if your down payment is below 20%, and a maintenance reserve of roughly 1% of the home's value annually divided by 12. Compare that total to the rent for an equivalent property. That gap, whatever it is the number you need to invest consistently if you choose to rent instead, for the comparison to be fair. Then research your specific market's historical home price appreciation rate over the last 10 to 15 years. not the last 2 or 3, which can be misleadingly volatile. Use that rate, along with your down payment amount and the principal paydown schedule from a standard mortgage amortization calculator, to estimate your home equity at the 5, 7, and 10-year marks. Compare that to what your down payment plus the monthly savings gap would become if invested at a realistic 7 to 8% average annual return over the same period. Finally, and most importantly, be honest with yourself about your actual time horizon. If there's a meaningful chance you move within 5 years, the transaction cost of buying will likely erase any advantage regardless of what the math otherwise suggests, and renting is almost certainly the financially sound choice for your specific situation. Here's the conclusion I want you to actually walk away with, and I know it's less satisfying than a clean verdict, but it's the honest one. There is no universal answer to whether renting or buying is the better financial decision in 2026. Anyone telling you with total confidence that one option is always smarter is selling you something, whether that's a mortgage, a sense of superiority, or us engagement on the internet. The real answer depends on your specific city's price to rent ratio, your specific market's historical appreciation trends, how long you genuinely plan to stay, what you would actually do with the money if you didn't buy, and what your individual life circumstances require in terms of stability versus flexibility. What I can tell you with confidence is this: the decision should never be made based on a photo in a family group chat, social pressure about what a responsible adult is supposed to do by a certain age, or fear of being left behind while everyone else builds equity. It should be made by running your actual numbers, in your actual market, against your actual timeline. Some people watching this video should buy a home this year. Some people should keep renting and aggressively invest the difference instead. The math, done honestly for your specific situation, will tell you which one you are. Trust the math over the group chat.